it comes to investing, we're bombarded with complex strategies and exotic theories. But one of the most effective investment approaches is also one of the most obvious. It's called the profitability premium, and it's based on a rather simple idea. Companies that consistently make money tend to outperform those that don't. Academic research shows that since 1964, highly profitable firms have delivered roughly 3.75% higher annual returns than their struggling counterparts. Yet, surprisingly, many investors overlook this factor entirely. Ben Edwards is an evidence-based investment consultant.
The profitability premium explains the fact that companies with high profits relative to lower profits typically outperform in the long run. So those with robust cash flows typically outperform those with weaker cash flows. The premium itself is somewhat related to the value premium. It's almost the sort of the other side of value, and actually why profitability and value tend to work really well together is because they'll do different things at different times.
But hold on, in investing there's rarely such a thing as a free lunch. If profitable companies consistently outperform, there must be a reason the market prices them differently. Profitability is still a risk factor with inherent risks.
Like any risk factor, it's a price risk factor. There must be a risk inherent in those companies which the market deems to be present and therefore puts a lower price on those companies as a whole. That's going to come with an inherent risk. Now, it can be more or less easy to describe what those specific risks might be for different risk factors. For a highly profitable company, that might be something like, say, the risk of competition, the attack on their margins, as an example, as one explanatory factor for the risk premium profitability.
The profitability premium is much less well known than, say, the size factor or the value factor. But, says Ben Edwards, there's a strong case for having exposure to profitability as well as size and value because they work so well in combination with each other.
I think it absolutely is a reasonable thing to consider for any investor. It improves certainly with value, it pairs really well because it tends to have uncorrelated returns and at times inversely correlated returns. And by that we mean that if you're owning one thing that's going up while the other's going down, you end up with the line in between. So it's diversification in its truest form. These aren't mutually exclusive. They're not sort of segmented component parts that we just sort of put together and expect them to work independently. Every company is part of this big risk factor model that builds our understanding of what drives returns from these different areas of markets and what we understand the characteristics that drive those returns.
This creates an opportunity for disciplined investors who can look past the excitement of hot trends and focus on what actually drives long-term returns. But implementing this effectively requires understanding how profitability interacts with other factors, something a good financial planner can help you navigate.